I'm Annie Massa, and I have with me here today Shundrawn Thomas, President of Northern Trust Asset Management, to talk about the future of the asset management industry. Welcome, Shundrawn. Now, one
Annie, how
thing
are you doing
that
today?
really thanks. One thing really that struck me moving into this year is how competitive the fund management industry has become. And in some ways, the COVID-19 crisis has sped up some trends that were already underway. What do you see as some of the most important forces shaping asset management right now?
So there are a couple of trends, Annie, when I think about the industry that are really impacting it. So from secular trends, I would start with just thinking about the meager organic growth that we see. And this is not something that's new. If you look over the last 10 years, last year was an exception in terms of flows, but we've averaged somewhere in the neighborhood of between 1% to 2% organic growth. And that's a very different dynamic than what we would have seen in the decades preceding that. And that's largely driven by demographic trends. The next thing I would offer is the persistent fee pressure. And people talk about fees, but one of the big things there, it's not so much just lower pricing. In fact, the major pressure that we're seeing from a fee standpoint is people actually shifting to say index and or other lower cost products, and that's important. Rising structural costs, if you look at what we have to do from a technology standpoint, compliance, innovation, those are secular trends that are affecting it. But there are some that are also beneficial depending on how you play them as a provider. The consolidation of both buyers and sellers that we're seeing in the market, the shift to what I call outcome-oriented solutions, investors willing to give up discretion in things like multi-asset solutions. And finally, probably one of the more important ones over the next 5 to 10 years, the digital innovation that we see shaping the future. And so when you think about the pandemic, it's effectively accelerated the pace of all of these secular trends. And so I think it puts us at an even more pivotal point in the industry.
Sure. Could you drill into a little bit? You mentioned fee pressure, technology, and shifting investor preferences. How has COVID-19 affected those various trends that were already in play?
Yeah, so I'll give an example. So if you think about it from a fee pressure standpoint, uh, when we were looking at last year, again, it was a relatively strong year in terms of market performance, assets under management, and we knew we were already seeing fee pressure. You fast forward into this year, and what happens is a couple of things. With the pandemic, if you think about specifically on the institutional side, oftentimes that sales cycle that's relatively long gets even more elongated, right? You also recognize that all of your asset owners or your investing clients are seeing pressure on their business. And so there's a natural shift then to think that much more intensely about fees or cost. And again, oftentimes it's not from the standpoint that they're necessarily demanding a concession, for example, on the price of the products. It's more so they're looking at how will they continue to move the portfolio into lower cost options that are going to be a benefit, because that's something that you can definitively count on if you save that money. If I think about the shift towards outcomes, really when we think about the marginal investor every day, right? The way that we would have talked about this in the 90s when we were in the business is you had this huge trend towards what was called the self-directed investor, the person that wanted to buy the hot stock or the fund. Now, it's not that we don't see retail investors in that way, but a dominant preponderance of investors increasingly want solutions that are delivering them an outcome, say for retirement or saving for a child's college educational expenses or those kinds of things. And they, in a sense, want it in one single SKU or product. And so they're willing to give up discretion in terms of choosing individual stocks or individual funds for the benefit of having something that's both outcome oriented, simplified, and more cost effective. So those are some examples of, as we've seen this more and more and people move to the digital environment, how those kind of trends get accelerated.
Sure. And one of the things I think that's made this industry so competitive recently has been the concentration of assets at the very top. So I wonder, what do you think
Yeah.
about where growth is coming from, especially for the fund managers who might not sit in that top 3 to 5 category?
Yeah, so it's interesting. So if we think about the business, so if you track the business from say the financial crisis that we had, And so we saw some different and very identifiable things that happened as a result of that. We saw a huge acceleration of the move towards passive or index investments, right? And so that favored all index investments, and in particular, we saw that demonstrated in the dramatic growth that you've seen in exchange traded funds. And the vast majority of ETFs are index managed products, right? And so you saw that. We also saw commensurate that what you're referring to is, I would like to say it's kind of not winner take all. You hear people say that. I like to refer to it as winner take most. But we certainly have seen a consolidation of the net flows among some of the largest providers. But what I would tell you that people don't tend to look into, if you peel back the flows and you were to look at gross flows, what you would see is actually significant shifts. So certainly we've seen some of the largest providers, usually those managers who have large index businesses, who are strong in areas like ETFs that are growing. I mean, you can think of those names that would come top of mind. But we've also seen providers over that same period of time, whether they're using quantitatively oriented strategies that are efficiently priced, and I can think of several names in that regard. All those who have moved towards what I would call more efficiency in terms of what they deliver and the price for which they deliver that, those have been relative winners in the environment. The last thing I would say in that shift that we shouldn't lose sight of, though, another large winner in the environment has been the shift that you've seen going into alternatives, and more specifically, private assets and private equity.
Absolutely. And I want to take a look at the active and passive tension that you were remarking on there. Bloomberg data shows that assets in actively managed mutual funds and ETFs still make up about 58% of those assets in the US. And that seems to have been steadily pared down over the past several
Right.
years. I wonder, what do you think about whether this moment that we're in, with all the volatility that we've seen, whether that will change any of that shift that we've seen, the steady passive kind of march forward?
Yeah, so it's tough. So what I would lead with this. For me, it's not sort of a philosophical view. So I want to be clear. For someone who's been in this business a while and who loves the science of investing, I believe when investors deliver a true value proposition, so let's say for an active manager, and they're truly doing great informed research, they're in segments of the market where there's the opportunity to differentiate what they're doing from a strategy standpoint, and they're truly picking securities, right? They're not just closet following a benchmark. There's a value for that. There's a role for that. The challenge that we see is historically many of the managers that we would identify as quote unquote active managers. When you look at the informatics of the actual portfolios that they manage, they don't differ materially from an index product or portfolio. And so the way you might think of it is those kinds of strategies, given their return profile and their costs, they're getting squeezed out of the market. And so if you ask me about then that trend, what I would call, again, increasingly a trend towards efficiency, do I see that abating? I do not, actually.
Got it. One more question on shifting investor preferences that relates to a different segment of the market. I want to take the time for a quick poll question for our audience. And the question is, will investors commit more money to sustainable funds, environmental, social, and governance-focused funds going forward? And the responses
Yeah.
are yes, as long as returns are there, maybe, or not really. So let's just take one moment for our poll.
Sure.
And it seems like the overwhelming responses coming in are saying yes, as long as the returns are there. How is Northern Trust thinking about sustainable investing, and what do you make of that response? We've got about 67% of our respondents saying that yes, investors will be committing more money to ESG products going forward. So how is Northern Trust
Yeah.
addressing that?
So a couple of things. So on this one, I would say I definitely am one that is betting with the wisdom of the crowd here. But I'll give some context for it. So for us, sustainable investing as a focus is not new for us. If I think about our nearly $1 trillion in assets that we manage, well over 100 billion of that are in sustainable investing strategies, and so it's a part of the market where we've had strategies for going on 30 years now. And so, but what's happened is more recently, there are a variety of things that I believe are permanently changing the demand curve for sustainable investing. And I think it will continue. So again, I vote with the 67%. Now, first of all, as we see over time, what we've seen in most recent years, particularly in the last 5 years or so, there's much more better availability and sources for criteria for ESG, so environmental and social and governance criteria. The actual data that you need to evaluate companies based on that, that's increased substantially, right? You're also seeing an increase, this is very important. Investors have a fiduciary responsibility to clients, and they think about delivering that risk-adjusted return. But now when we see research being done, and we do this ourselves, where we can see the relevance of these, what I would refer to as performance indicators from an ESG standpoint, in driving risk-adjusted return, now there's a more of a proof case to that today. So it's not just about the intent of the investor. There's a broadening of the investor demand for sure. If you look at markets like Europe, it's table stakes there. But now when we see the move afoot in the US and even different parts of Asia, that's important. And then finally, you see more of a regulatory or governance pressure in different markets around the world. All those things work together. For us, it's really integrated in what we do. We not only have the investment innovation and the strategies themselves, but what we're doing from a stewardship and a governance standpoint, going through how we think about the companies that we invest in, how we vote our proxies, all those different things. All of that is incorporated into a fulsome sustainability effort. And so people are not looking just at the efficacy of our investment strategies. They're looking at our thought leadership in that regard. And they're also looking to us for how we can support them from a stewardship standpoint. So that's what we've been doing at Northern Trust for years now. And I think that's what's driving the opportunity set for us.
Sure. And how do you avoid the risk of virtue signaling and greenwashing from some of these funds? What does it take for a sustainable fund to stand out from the pack with so many companies now launching these kinds of products?
Right. So a couple of things. So the thing I think that's most important is at the end of the day, right, you have to have a clear discipline to the investment science. And so if we're looking at any kind of investment, right, we're thinking about performance on three different axes, right? We're thinking about how does the strategy deliver against its investment objective? So there has to be a clearly stated investment objective, and there has to be articulated value delivered to the investor, right? The second thing is, how does that investment perform relative to, again, a risk-adjusted return? So think about the actual performance of it. And we're able to measure that, and we can look across categories and all those things. And then the final thing we look at it is relative to the other alternatives in the space, whether they be other sustainable investing strategies or whether they be other strategies that are not sustainable investing strategies. So when you have a clear emphasis on identifying those things, demonstrating the value proposition, and being clear on the measurements, I think that's how you avoid, in a sense, these concerns over quote unquote greenwashing or other things like that. It's actually simply stated, holding it to the same standard and measure that we would any other investment strategy or investment product.
And I wanted to ask you about the S piece of ESG, with the reckoning happening in America and all over the world over police brutality and racial injustice. I wonder, since the asset management community is so homogenous still, with just about 2% of executives in this industry being Black, how is Northern Trust thinking about this cultural moment? And what do you think that asset managers need to do to participate meaningfully in this movement?
Yeah. So a couple of things, and I appreciate the question you asked. First of all, the moment can't be a moment; it has to be a movement. It has to be driven both from a standpoint of a clear set of vision and values by a firm, right? So it has to be part of how you see the firm in its best future. That's your vision. And it has to be consistent with the deeply held beliefs of the company, the firm, embedded in that culture. And then, of course, it speaks to delivering whatever our mission is, including what we do from a financial performance standpoint. Now, when I think specifically of our journey, it hasn't been a moment for us. I'm very fortunate in this regard to work with a firm where we're working on things and we want to improve. We've been committed and on a path to driving more diversity, equity, inclusion in all senses. So we start at the top. So that's the first recommendation that I give. And I think it's so important if you're going to drive diversity. So many people want to start at the bottom of the organizations. We started at the top. So if I think about my asset management executive team that we've been able to build over time, and I have the privilege of leading. So 9 of our 15 members on our executive team are either women or persons of color. And even if you wanted to speak specifically to African American, 3 of the individuals on the team. And so these are the senior most leaders of our global organization. And so we built that over time through a serious commitment to making sure that opportunity is equitable, both in terms of when we think about hiring and promotion. So that's the first thing, start at the top. The second thing I would say that firms need to do is you have to think about who you partner with and who you do business with. And if in a short review you look at your providers, the firms that you work with, the vendors, and there's no diversity among them, both in terms of the ownership of those businesses and even in terms of the employee profile of those companies, then you need to think about how you spend your dollar differently to drive that. So I think that's another important part of diversity and inclusion, because we can influence it in that regard if we're really committed to that. And then the last part of what we think about is what's the nature of the measurement that we're doing every day. So it can't be something we talk about, but it's not one of our most important focuses from a measurement standpoint. So for us, we have public scorecards we use in our business. We talk about where we are on these metrics all the time. There is clear accountability and ownership of it. It starts for me and my expectations that I have, and it flows through all of the senior partners in the business I work with. And so those are the primary things I would start with in terms of starting at home for people to drive diversity, equity, and inclusion.
More accountability, more transparency. We have another ESG question coming in from our audience. With the shift toward retail investment and the importance of the retail investor, at the retail level, do you expect that investment advisors are going to be encouraging their clients to move in the ESG direction? Do you think that that will be a focus from the advisor level?
Yeah, so I think you're going to see it evolve in different ways. One of the things I would offer is with respect to advisors, we definitely see communities of advisors who are really interested in sustainability. But to be fair, it differs from practice to practice. So I do see that growing over time, especially because of some of the things that I mentioned in terms of the availability of criteria to evaluate these strategies, more relevance in the performance indicators. So you're going to see that continue to grow, but there's going to be, again, pockets where the growth is stronger. With respect to retail investors, I think what will happen is individual investors are becoming more assertive in terms of what they want with the impact of their investment dollar. So I think you're going to see, in addition to, in a sense, a push from the advisors, you're going to see a pull from retail investors. Now, that will be affected by different things. Like, for instance, there's some potential regulatory things that are afoot to suggest what sustainable investments should play, how they should play a role, rather, in, say, 401ks. So we'll have to see how those things play out. But in general, I do think you're going to see that push. And I think as we look further out into the future, I wouldn't be surprised if we're talking 3 or 5 years from now, and for certain investors, it becomes the marginal decision point. The performance just becomes table stakes. And so I really want to know that once I have the requisite performance, that the investment mandate aligns with my personal values.
Great. And one last question before we wrap up for you. Consolidation was already happening in the asset management industry going into this year, with Franklin Resources and Legg Mason agreeing to merge and other major mergers. What do you think that the COVID-19 crisis and the fallout from it economically will mean as far as that consolidation trend?
So here's what's interesting. So what I mentioned in terms of one of the trends is consolidation of both buyers and sellers. So I can pick any segment of the buying population, registered advisors. I can pick intermediaries. You see a consolidation going on there. You also see it with the buyers, right, in terms of the providers, the asset managers. But the first thing I would say is much of the consolidation I actually expect to see is happening organically. You said it yourself in terms of how, quote unquote, the proverbial winners have gotten larger. And so I think that's going to be the biggest manifestation over time of the consolidation. Now, alongside that, do I absolutely believe that we're going to see more pickup in M&A activity? For sure, because the pressures that will result in terms of the clock getting sped up will drive people to look, I think, more at certain inorganic opportunities. I think you have to be very mindful. We know over time that many of those M&A transactions sometimes destroy more value than they create. So you have to be really thoughtful, particularly from a cultural standpoint. But certainly, we're going to see consolidation of the M&A kind, and I think we're going to see predominantly a consolidation of people taking share, and in a sense, the middle part of the market becoming more and more squeezed.
So expect that squeeze on the middle part of the market. Thank you, Shundrawn. That's all the time we have. I can't thank you enough for your time here today.